Hi, my name is Wayne. I trade options for a living, and I'm known around some of the trading forums as Wayne L. Naturally, I think options are a fantastic investment vehicle, but almost everywhere I read and hear people speaking about options, in articles on the internet, in options newsletters, advertisements for courses, and indeed the contents of some of those courses, and in the spam that constantly litters my inbox, I see some of those ridiculous nonsense, lies, mistruths, and myths about options trading. Often it is to try to sell you their offering by raising unrealistic expectations. But sometimes it is the sheer ignorance of someone with not a lot of experience. Sometimes it is both. So basically, I'm starting a series of videos that highlight the myths and mistruths about options trading to try to give people a more solid foundation of knowledge when searching for information on options. This first video is about credit spreads. First, let's have a look at what a credit spread is. A credit spread is one variation of option spread known as a vertical spread. A vertical spread is the purchase of one option and the sale or writing of an option of the same expiry but a different strike price. When we say it is a credit spread, it means that we receive a credit when initiating the trade. Logically, that means that the credit we receive from the written option is greater than the debit paid from the option we bought. The vast majority of credit spreads traded are of the bull-put spread variety. Almost always, they are out-of-the-money bull-put spreads. That means an out-of-the-money put is sold and a further out-of-the-money put is bought. This is constructed by selling or writing an out-of-the-money put option. That is, a put option with the strike price below the current share price. A further out-of-the-money put is concurrently purchased to cover the possibly indeterminate loss of the sold put. That is, we buy a put with a lower strike price than the one we've written, resulting in a net credit. Maximum profit is attained if the price is at or anywhere above the sold put strike at option expiry. Maximum loss is suffered if the share price is at or below the bought put strike. When constructed in this way, the maximum loss is much greater than the maximum reward, but the probability of profit is high. That means there is a higher likelihood of the trade making a profit than a loss. Hopefully, the higher number of small wins offset the fewer but much larger losses. Here is an example of a bull-put credit spread with its payoff diagram. With the stock trading at $50 and the options 36 days till expiry and implied volatility at 26%, we are going to construct a bull-put spread with an 80% statistical probability of maximum profit at expiry. The first part of the trade is to write some out-of-the-money put options. In this example, we are writing the 47 strike puts, and we're writing 10 contracts of 100. That is shown here by the little red arrow. The next part is to buy an equal number of put options of the same expiry, further out of the money. In this case, we are buying 10 contracts of the $45 strike, shown by the green arrow. That gives us the diagram you see here. The credit received in this example is $262, which is also the maximum profit if the stock is at $47 or above at expiry. This is measured against a maximum loss of $1,738 if the stock is at $45 or below. The maximum profit in this example is 15% of the maximum risk, but the model shows that statistically this particular spread had a 20% chance of closing below the written strike at expiry. Now, you don't have to be a Rhodes Scholar to figure out that the odds are not in your favour in the long term if you trade spreads like this one. The model also shows a 33% chance of the stock being below the written put at some time before expiry, so you have a 1 in 3 chance of high anxiety before this expires, and with the possibility, or a 20% possibility, of a loss. Not all credit spreads have the odds against you like this, but this is to demonstrate that what the hypesters say and what the real mathematical truth is often two very different things. Let's enter the twilight zone and the world of the option spruiker. This is from an article I pulled off the internet with the intention of driving traffic to the author's website. Let's read the first paragraph. The beauty of options trading is that it opens up a lot of alternative ways of building wealth from the stock market. Well, that part is true. Options trading offers a multitude of differing risk and reward scenarios that are very different to straight-out stock trading. But then the author goes on to say, recent events have shown that the buy and hold approach to stock trading carries substantial risk. With a volatile market, a safe in and out approach is much more desirable. Well, that may be true too, so long as the in and out approach is actually profitable. But not many in and out traders are profitable. Most lose, and there is more to it than that. The author here is referring to the recent market dive in the latter part of 2008 and early 2009. But based on what I've shown you already, do you think the bull-put spread would have saved you from any losses? Well, maybe, but most probably not. It depends on a few different factors. Some of the traders with the most calamitous losses in the recent rout were actually credit spread traders. And I stress that it wasn't the strategy's fault, but rather the individual trader's fault, by relying on a bit of credit spread baloney and inappropriate position sizing. He goes on to say, of all the option trading strategies available, trading credit spreads is by far the safest and simplest method. Well, it offers a differing risk profile than straight-out stock trading, but it strikes me that credit spreads are more complicated than straight-out stock or simple long option trading. There is also no such thing as the safest strategy. In option land, there are only differing risk profiles, and any strategy can be made extremely dangerous with inappropriate leverage. Then he says, it has a risk profile significantly lower than stock trading, and it offers a much better profit than any type of stock trading strategy around. Well, that's just rubbish. The trader can crank up their risk significantly higher than stocks with credit spreads, and we have seen that credit spreads actually limit profit potential. If I think the stock is going on a moonshot, the credit spread is not going to benefit from any massive move. And if I'm trying to trade a moonshot, I'll take another strategy that offers unlimited rewards instead. I'll trade bull-put spreads under the right circumstances, but the profit potential most certainly is not much better than anything else around in all circumstances.